Good evening, everyone. Today we're looking at modern management accounting techniques. So that means that we are continuing for our last topic. And other modern management topic, we'll be looking at several subtopics under this broad topic. We'll look at target costing. We'll look at life cycle costing. We'll look at throughput accounting. Then today we're looking at backflush costing and activity-based management, which is the management part of activity-based costing, and we'll be looking at environmental accounting. Environmental accounting. So these three subtopics, they are is only backflush accounting and backflush costing that has calculation. While the other two is majorly theory. So should be able to read up the notes after tonight's class. Okay, what is backflush costing? This this is a recent development approach or costing approach for just-in-time production and just-in-time purchase because technology have taken over the production processes now, and some producer does not have a warehousing, so because of the lack of warehousing or shortage of space now, so they have to produce in a just-in-time um, techniques. Now, the just-in-time techniques. Now, what are the accounting approach in recording the transactions, those inventory purchases, labors and overhead? How can you record it in a just-in-time production? So the Japanese, the Japanese now introduce these costing techniques, which is known as backflush costing, or you say backflush accounting. So let's look at from the note. Let's explain what is backflush costing. We said is a more simplified costing system for allocating cost between inventories and the cost of goods sold. Now, in just a way, this is how you can allocate costs, how you can record costs between the inventory and what cost of goods sold, which is the finished goods. Now, the the purpose of this is to eliminate detailed accounting transactions rather than tracking the movement of materials through the production process. A backflush costing system focuses first on the output of the organization and then works backward when allocating costs between cost of goods sold and the inventory, with no separate accounting for work in progress. Now that is backflush. From the names, as the name implies, we said backflush. That means you've already produced before you now start recording the cost of inventory from the inventory down to your cost of production. Now, in this backflush accounting, it is a technique that tries to reduce the accounting record in the production phase. So it focuses majorly on inventory, the inventory that you purchase, and the cost of conversion, that is conversion cost, then your finished goods, which is the cost of goods sold. These are the three major transactions the backflush accounting recognized. Also, backflush costing is suitable for use in a just-in-time environment. That is why I said it's very useful in a just-in-time environment where there is no time to start recording. When there is no time to start tracking the transaction fees, rather than looking at the movement in inventory, to the finished goods. So they've tried to reduce um the accounting delay in recording transactions in a manufacturing phase. So they are trying to shy away from that. Then after the production, they now have to now recording. Now the costs are attached to output only, thereby simplifying the costing system. Backflush accounting is the name given to the method of keeping accounts, cost accounts employed in backflush costing. The, the two the two types are almost interchangeably. So sometimes the backflush accounting can also be interchangeable, also be interchanged with what backflush costing. Backflush costing is approach for organizations trying to keep inventories to the very minimum. So in backflush costing is always used for organization where where inventory is of is not an asset. That's why we say in this modern accounting techniques, inventory is not an asset. Unlike in financial accounting that say inventory is an asset. In modern inventory is not an asset because inventory will always you always incur some expenses on inventory. So inventory in another way around, it will not serve as an expenses as a cost to the organization. Why are you keeping inventory? You will incur storage costs on the inventory, which are not expenses. So inventory reduces profit. So inventory is not an asset. So that is why inventory should not be kept in production phase. So it is simply an expense. It's simply an expensive and non-value adding activity that should be eliminated. So that's why we said inventory is not what should. So inventory does not add any value to any organization. Why are you keeping inventory? There's no value. The only value that inventory has is the stock at cost. And when you know when you can identify your your customers and the pattern in which they request, then you should be able to produce at the time required. Now, Backflush accounting. Now, what is Backflush accounting? Backflush accounting, Backflush accounting with two trigger points. In Backflush accounting, we have two trigger points, two phase of recording transactions. Is either use trigger point one or when there is just when you are using two trigger points. Now, an event that leads to the recognition of cost is called a trigger point. In Backflush accounting, any event that leads to the recognition of cost may incur inventory. So inventory will lead to you to have led to the recognition of cost. So you now said inventory, that point is a trigger point. When you incur or when you incur labor in production, that point of incurring labor is also called a trigger point. So in backflush accounting we have major two trigger points, two major way where you can incur cost. So the first trigger point is only when there is inventory. A backflush accounting system has one or two trigger points. When costs are recorded, there are two trigger points. These are usually one, the purchase of raw material, and two, the manufacture of completed products. Now, you should understand that in backflush accounting there is nothing like work in progress. We don't keep work in progress. So we don't keep work in progress. Work in progress is not an asset. So we don't keep work in progress. In matter accounting, what we recognize is when you incur your raw material and when you convert them to what, to finished goods. So you don't keep so you incur raw material when you know you want to produce, and you produce what you can, you incur what you can produce. I mean, you don't incur raw material instead that you incur and you have a sum as a work in progress. So in bachelor accounting, we try to eliminate work in progress. Now, trigger point one. What are those things that you need to understand when it comes to trigger point one? The direct material costs and other direct production costs are recorded in the usual way by debiting by debiting the cost to the appropriate account. It is helpful. It is helpful. The trigger point one, as I said, it it is helpful to think of these accounts as being like expense accounts where the costs are held until they can be included in the cost of cost of sales, and to a much lesser extent into closing inventory. So trigger point one is always used to record costs incurred during production. So for your direct material, direct labor, and what and overhead. So all these are what you are going to be debited under trigger point one. So that trigger point one, it is those initial costs incurred in production, such as the inventory, direct labor, and what overhead. Now for the trigger point two is for cost of production to finished goods. Now, trigger point three is equal to finished goods when production is completed. So when you complete your production, then you open a trigger point two. And trigger point two is for finished goods. The credit entry out to the suspense account at standard cost. So after your finished goods, when you finish goods, you have to credit it. So you have to credit it, which is the standard cost of what of production, times what is being what um dispatched. That is what is being sold, or is being sold. Balances on the suspect accounts after these entries represent what the closing inventory or finished goods or cost variance. The debit recognized in the finished inventory accounts move to a cost of goods sold account also immediately. Remember that just in time manufacturers. So you should know what just in time manufacturers what means. Now, Backflush accounting with one trigger point, and even simpler Backflush accounting system as just one trigger point. The manufacture of finished units in this system, the purchase of direct material is not recorded. Conversion costs are debited, including a separate account or account as before. When there is a trigger point, when there is a trigger point, the cost of production is debited into the finished inventory when production is completed, with the credit entry to the suspense account as standard cost and to payable for raw material. So let's look at this illustration one on how to account for what a Backflush accounting. Illustration one. Chelsea Limited makes a single product which is called P, which has the following standard cost. So you are given the standard cost: raw material, direct labor, and overhead. So it's 50 naira. During the period, it incurred the following cost. So you charge the following cost: raw material purchase, which is 2,030,000; conversion cost, which is direct labor and overhead. So both of them added together give us 3,035,000 naira. Now the company made 100,000 units of product P and sold 98,000 units. The company uses a Backflush costing system with a trigger point at raw materials and and at completion of production. You are required shows how Chelsea Limited will treat the above using a Backflush costing. So how will they treat this above using a Backflush costing? Now remember that the first trigger point is the record of what the purchase of raw material. Now you open your ledger. Now you debit your raw material with the raw material purchase. Now if you purchase the raw material, you debit the raw material and credit what the creditors. But that creditors account is of no use. So you can put it there as a working, it might not. But the major thing we have to understand is the actual costs that affect the production, which is the raw material. Now the raw material is debited. The next phase is labor and overhead. These are conversion costs. You open the conversion cost account. The labor is being debited, which is bank. That means labor you have to pay them. So which is bank. You credit bank and debit what labor. Then overhead That is, it's also a creditor. You might not pay them. So you debit the conversion and credit your overhead. Now, the trigger point two. The trigger point two is the record of manufacturing units. So we think about manufacturers was 100,000 units. Now, the trigger point two is that the first thing is to is to close the raw material and the conversion account. Now you credit the raw material using. Let's remember that you use what was produced times the cost, the standard cost of raw material. The standard cost of raw material. So the standard cost of raw material is 20 naira times what was produced, which is what 100,000. 100,000. Now for the finished goods was merged. We merged labor and overhead together. So the finished goods we have 8 of labor and 22 of overhead plus together making 30 times 100,000. You give us 3 million. So you credit the commercial cost and debit the finished goods. The next thing is to calculate cost of goods sold. How many was how many how many units was being sold? The unit that was sold was 98,000 units. So you multiply 98,000 units times the standard cost of what of production, which is 50 naira. So then we now have 4,900,000. Then you now look at the difference is a what is a closing balance. So this is how you record your Blackfish accounting. It's just like it's an accounting freeze. Just like your if you look at your previous level, which is the interlocking. Yes, the interlocking. This is just like so just understand. Let's just understand how to record our Blackfish accounting. The major thing we should understand is the meaning of it and how to explain Blackfish accounting. The two trigger points. Now look at this illustration too. Let's look at illustration two. If Blackfish costing is used, the management accountant of Barcelona PLC might extract the following information from the monthly accounting transaction. So the record and production records. So you are giving that. I said orders completed and dispatched in July was 196 units. So the what was completed and dispatched. That dispatch means that was sold is 196 units. Orders prepared in advance in 1st of July. So in advance means our opening cost for the July. Then why for the closing cost of July it was 2 units. And we have a scrap item. We have a scrap. Scrap was part of what was produced of what 5 units. Then the conversion cost. The conversion cost, which is for both other direct expenses excluding material, is 250,000. While material cost for that month is 475,000 naira. Now you are required. Shows how Barcelona PLC will treat the above using backflush costing. How they treat the above using backflush costing. Suggested solutions. Now let's look at the trigger point one. The trigger point one. Now the raw materials. Very easy. The trigger point one. The raw material is 475,000. Then the commercial cost was given to us, which is 250,000. Now for trigger point two, which is to when you manufacturing of the product. Now you have to close the raw material and close the conversion cost. By closing it, you have to use the cost per unit of the raw material. Now So how many units was produced? We are not told, but we told the unit that was sold, and we are giving the opening and the closing. Very simple. You have to look at the workings. Workings is calculation of cost per unit of production. So what is cost per unit? What is cost per unit? Now the total cost was 725,000. Why the unit that was produced was what, 200? How do you get 200 unit that was produced? You have to look for it. You have to calculate the cost per unit. And the cost per unit is looking at using our budgeting. What to know? Using budgeting techniques to know what was that will be produced. Now, if you know what you want to sell, you know what you produce. Now, what you sell plus any scrap that you have during production, you add it together. Then you add your closing inventory. Then you less your opening inventory. You have what the unit that was produced. Then you divided by the total cost. You have your cost per unit. Now, the cost per unit is what we use to get our cost of goods sold. Then multiply by our scrap value. You our scrap value, you credit this account and you debit your scrap value. Then so the difference between your debit side and credit side is your closing inventory. It was your closing inventory. Your closing inventory. So with this, we should be able to understand the Backflush costing, how it's being recorded, or Backflush accounting. Now, the possible problem with Backflush costing, what are those problems that these techniques entails? So let's look at those problems. One, the successful operation of Backflush costing rests upon predictable levels of efficiency and stable material pricing and usage. In other words, there should be insignificant cost variance. So we are saying that, remember that in Backflush accounting, the major reason that we should not have a closing inventory, because once you have a closing inventory, that means you have to go and drop it in your store, as as a store, which is as a closing inventory. Now that inventory that you go and drop in your warehouse will incur costs. That's the reason why in Backflush accounting we try to minimize closing inventory. So we ensure that for you to practice Backflush accounting, there should be stability in material pricing, so that there won't be closing inventory. Two, it is only appropriate for just-in-time operations where production and sales volumes are appropriately equal. So remember that Backflush accounting is very, very important or appropriate for just in time. So where you use it more just in time. So Backflush accounting is not used for other production techniques apart from just in time. Because in just in time, we don't there is what you produce is what you sell. So no closing inventory or closing goods. Some people claim that it should not be used for external reporting purpose. If, however, inventory are low or are practically unchanged from one accounting period to the next, operating income and inventory valuations derived from Backflush accounting will not be materially different from the results using conventional systems. Hence, in such circumstances, Backflush accounting is acceptable for external financial reporting. So it is vital that adequate production control exists, so that cost control during is maintained. So Backflush Backflush costing or accounting is always used where there is an adequate cost control system. Now, what's the advantage of batch flush accounting? It is much simpler as there is no separate accounting for work in progress. You know that backflush accounting, there is no separate accounting for work in progress. So it's very easy to compute, unlike the conventional techniques. The, the number of accounting entries should be greatly reduced as are the supporting vouchers, documents, and so on. So in preferred accounting, because there is it's not cumbersome. You don't have to open different ledgers. So you are opening few ledgers. So that is the reason why the accounting entry that will be entered in backfish accounting will be very reduced. So there won't be too much sorting documents in a batch push system. The system should discourage managers from producing simply for inventory since working on material does not add value until the final product is completed also. So that's the reason I would say this approach um it helps managers not to produce and go and keep in warehouse, because inventory does not have any value. So inventory is a non-value adding activity, so you don't have to produce and keep. So it helps to reduce the expenses and it also helps to reduce expenses associated with what inventory, such as storage costs and security kind of security costs and the rest. Now let's look at activity based management. This is a management techniques for activity based costing. Activity based costing is a very important topic when it comes to performance management, because I can normally set questions on activity based costing. Activity based management is the process of focusing on the management of activities to improve the from value received by the customer and the profit achieved by producing this value. So we want to look at, okay, what are the value we are receiving, and what are those and what are those and what are those and what are those profits we receive from the value. Activity based management is a management process that uses the information provided by an activity based cost analysis to improve operational profitability. So this is the management techniques used to improve um, um, the management process or technique used by what ABC, which used to improve what profitability. The aim is to achieve the same level of output with low cost. There are two main types of activity based management. We have two major types of activity based management. We have two major types of what activity based management. We have the operational activity based management and what the strategic activity based management. Now, now the operational activity based management is doing things right, which is what the operational activity based management is what doing things right. This relates to making the organization more efficient by reducing the cost of the activities and eliminating those activities that do not add value. Why the strategic activity based management is what doing the right thing, doing the right thing. This this is which essentially involve deciding which products to make and which customers to sell to based on the more accurate analysis of product customer profitability that activity based costing allows. So under this broad topic, we also will look at what products and customer profitability, the uses of activity based management with other performance improvement strategies. ABM does not have to be used in isolation. Activity based activity based management does not have to be used in isolation and can be used alongside performance now and can be used alongside with performance measurement improvement strategies such as the total quality management TQM. So you should understand that the ABM is also used alongside with total quality management and Six Sigma, Six Sigma and business process re-engineering, where the information provided can support a project. Now, in total quality management, costs are analyzed into costs are analyzed into cost of conform conformance, like appraisal and the prevention cost. Now, and cause of non-conformance, which is internal and the external failure cause. Now, this is a topic that will be my colleague have emphasized, or my colleague have thought about it. That he has taught the topic. Now, the topic is cost and cost quality control. So the aim of the total QM is to reduce the cost of non-conformance. Reduce the cost of non-conformance. Activity-based management enables organizations to more accurately calculate these quality-related costs and to monitor improvement. Why the Six Sigma and business process improvement and business process engineering aim to achieve the large one of improvements in particular business processes relating to efficiency and better customer satisfactions. ABM can support these methodologies in several ways. How can ABM support all these cost methodologies? So one, it helps to identifying process that need improvement and establishing priorities, providing cost justification for producing for proceeding with the project, monitoring the benefits of the project. So APM will help you to achieve these three methodologies when you want to use other cost controls. Now, uses of ABM. What are the uses of ABM? Oh, ABM have so many uses, so we can read up the uses and understand them on our own. So one, ABM can be used as a cost reduction technique. It can also be used to achieve significant redesigning of processes, and it serves as an alternative to business process reengineering and as an approach to process re-engineering. So it analyzes the cost and the value added elements of various elements in a process or in a product or service mix. It is used to redesign it radically to obtain a competitive advantage. ABM analyzes the management of activities in order to improve the value obtained. So all these are what ABM does. Now the other topic that we'll be looking at is what is environmental accounting. Environmental accounting uh, is also treated under our CSME, which is a corporate strategic management and what ethics. Now I want to talk about environmental accounting in performance management, because environmental accounting and environmental costs, they are also manufacturing costs in which a production manager should be able to identify in order to inculcate such costs in his production costs in order to know his profit and work within the regulatory framework of the country in which he is producing. So they won't have to incur penalties, and face the consequence of not complying with environmental policies and guidelines. So my production manager should able to understand this environmental accounting. What are those costs that are relevant to environmental accounting? Now, what is environmental management accounting (EMA)? Seeks to ensure that companies are fully accounting for the environmental costs for their actions. For their actions, greater awareness, greater awareness of environmental costs we equip we equip management to make more informed decisions. Ultimately, the aim ultimately ultimately the aim being to improve corporate environmental performance. EMA is the generation and the analysis of both financial and non-financial information in order to support internal environmental management processes. Environmental costs. Now, let's look at environmental costs. Environmental costs are important to business for a number of reasons. One, identifying environmental costs associated with individual products and services. For pricing decision, environmental cost is also needed for what? For pricing decision, to ensuring compliance with regulatory standard, and then for potential for cost savings. So you need to identify your environmental cost in order to achieve a cost savings. The impact of environmental behavior on performance financial performance. Businesses who pay insufficient attention to their environmental behavior may find this will adversely affect their financial performance, because when you don't pay attention to your environmental activity, or and those costs, those when you don't pay attention to costs that will affect your production, or those environmental costs that will affect your production, then the company might have what? An adverse financial performance. One, the direct cost may increase as a result of wasteful resources utilizations and additional cleanup costs. So we have direct costs that affect production, which is those costs that affect production, like your cleanup, your cleanup of the product. Now, for example, if you want to produce now, the machine, that means you have to, if the cost of cleaning up the machine for production is a direct cost. It's a direct cost because if you don't clean up the machine, you'll be able to produce the quality of product that you required. So revenue, it also affects revenue, may suffer through reputational damage, loss of sales, and potential customer boycotts, with will have a negative impact on sales income. Now, it also affects your revenue, because when there is damage, or whereby government fine a company for not complying with environmental policy, or the company's waste affect the livestock, and the aquatic product, or aquatic animals in the water, or affected the river, or affect or pollute the environment, this will have a bad reputation. It will affect the goodwill of the company, and as so doing, by so doing, it will affect the sales of that company. People will no longer patronize the company because of the bad name the company have company is having in the community in which it's operating. So that will reduce its customers. So reduce its customer. Financial stability can be a threat as brand values deteriorate, leading to cheap and insurance cover may be withdrawn. So with such, um the insurance cover may be withdrawn. Further failure costs can take the form of penalties, fines, and potential limitless lawsuit against the organization. Categor- Categorization of environmental costs. How can you categorize environmental costs? Environmental costs can be categorized into four major headings. Into four major headings. One, environmental prevention costs. What are those environmental prevention costs? What are those costs that are related to what environmental prevention costs? This relate to expenditure paid to prevent or limit the effects of adverse environmental impact from occurring. So what are those things that will prevent you? Environmental prevention costs. You have to identify those costs. Now, like cost of employing environmental experts. So this experts will help you to prevent environmental costs. So environmental appraisal costs relate to expenditure needed to determine whether an environmental policy is meeting its planned objectives. Internal failure costs, those which are borne exclusively by the business to manage and limit the impact of hazardous waste which has been produced. So what are those internal costs to reduce this cost that will be been produced? External failure costs are costs which have been caused by company through actions such as hazardous waste production, but which were not managed or contained, and so the costs have also been borne by the wider society. And a different method of accounting for environmental costs. What are those methods? There are four methods that may be suggested as ways of accounting for environmental costs. One, the input and output analysis. This approach balances the quantity of resources that are imputed with the quantity that is output, either as production or waste, reconciling inputs with their physical output quantities in terms of volume and also in monetary terms. Force the business to account for all wastage and full environment impact of the product. Now, the flow cost accounting. This is really inflow and outflow analysis, but instead of applying simple to the business as a whole, it takes into account the organizational structure. Resources inputs into the business are divided into three categories. One, the material, the system, and the delivery and disposal. Now, the material, the resources used in production and storage and storing of raw materials. System, the resources used in the system such as production and quality control. The delivery and the disposal, resources used in delivering to the customer in disposing of any waste. Now, environmental costing, we also have a life cycle costing. In environmental costing, we also have the cost associated with life cycle. This type of costing aims to account for the total cost of a product during its whole lifespan. So in life cycle costing, you must also inculcate environmental costs in our life cycle cost. So when you look at the under your introduction, we should also look at what are those environmental costs in your life cycle costing. This includes costs incurred at the research and development stage until up up till the period after product is being withdrawn from sales. So under each phases, what are those environmental costs associated with each phases? So you need to identify them. This relevance to EMA is that some of these costs may be environmental related. This can be particularly significant at the end of a product life when expenditures such as the site clearance and disposal of unweighted inventory may be incurred. Now, I'm saying that under this phase, we should be able to identify our environmental cost, but environmental cost is always at the withdrawal phase, and because withdrawal phase is when you try to withdraw the clearance and decommissioning of the product. So you have to environmental cost is always associated with that phase. Environmental activity based costing is also a technique we should be able to look at in our ABC. We should look at the environmental driven cost in our production. So activity based costing can be applied to environmental costs, and therefore environmental cost drivers can be identified. Each established these costs can be better assigned to the activity which caused them. Then the process of cost reduction and better control can begin. So we have the internal environmental costs and the external environmental costs and the external environmental costs. So we should be able to look at all those examples of costs. We said these are costs that directly impact on the income statement of the company. This may this There are many different types. For example, improving system and checks in order to avoid penalty fines, waste disposal costs, product take back costs. So regulatory costs such as taxes, upfront costs such as obtaining permission, and back end costs such as the commissioning costs of projects. While the external costs, these are costs that are imposed on society at large but not borne by the company that generates the cost in the first instance. For example, the examples are these are the carbon emissions, usage of energy and water, forest degradations, forest degradations, and healthcare costs and social welfare costs. We also have identifying environmental costs, and controlling environmental costs. Such a business has to define, identify, and allocate environmental costs. It can begin the task of trying to control them through environmental management system. We have the ISOs. So this is a standard that covers about environmental cost. So we should look at this and read this topic up, and let's try to solve those questions. Look at this question we saw before, and understand the topics. So with this what remain under this broad topic will be on product profitability and customer profitability. With this, we've come to the end of tonight's class. Good night.